On May 7th, BMO hosted a discussion to explore the evolving landscape of recent tariffs and trade policies and their direct impact on the North American technology sector. Let's take a listen.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
Good morning or afternoon, everyone, et bonjour à tous. My name is Andreas Rubenser-Paim. I head up technology banking at BMO's commercial bank here in the US. I'd like to start today's meeting actually with a quote. I'm going to quote Justin Fox, a columnist on Bloomberg. Quote, economic uncertainty has never felt this uncertain, end of quote. So today I'm being joined by my fellow colleagues, Dr. Scott Anderson, our chief US economist from BMO Capital Markets. Brett Anderson, no relation, also director in global markets. Sherilyn Mills, managing director on our FX structuring team, and Nicholas Ray, a VP on our global trade team. You've probably listened in to or participated in quite a bunch of macroeconomic updates over the last weeks. This is not going to be another one. Also very helpful, but today we're really going to drill into the technology industry. We're trying to keep it short and relevant for you as much as this is possible. And our goal is actually to have about 10 minutes plus for Q&A at the back end of this call. So if you do have a question now or later as we go through our talking points, there's a Q&A box at the bottom of the screen. Just enter your question there and we'll try our best to get to it at the back end of the call. A few opening comments from my end briefly. First of all, things will keep on changing. We don't have, as you just heard in the quote, not a lot of certainty right now. And so today we're not going to pretend we have the answer to all the problems. We don't have a solution, but hopefully some guidance. We want to help you better understand how to analyze the situation that you're dealing with, and hopefully give you some ideas and tools to tackle those issues. Also, since we are talking here within our beautiful tech community, I'm sure a lot of you, or many of you, maybe all of you, will remember the US-China trade war that ensued during the first Trump presidency, which then was followed by the pandemic. So I think it's fair to say a lot of the people in the audience here today will have dealt with somewhat similar issues, maybe not quite to this magnitude, but somewhat similar issues before, especially if you're on the manufacturing side of tech, where you have to think about manufacturing locations, supply chains, and the like. And so maybe because of those past experiences, you already have built up different manufacturing sites, engage with different contract manufacturers, maybe diversified your supply chain a little bit. And if not, I guess now would be a really great time. Point is flexibility on the manufacturing and supply chain side, from my perspective, is key. And actually, that's probably a perfect segue into my first questions that I'd like to Dr. Scott Anderson. So on the economic side, Scott, you and I have talked about this quite a bit. And, as we've discussed, in tech, you could slice and dice the sector like a dozen different ways. And those subsectors all are somewhat different and certainly many times behave differently from an economic and business perspective. But I do kind of for this purpose, like to lump them into two big buckets. So one is we manufacture things, widgets, be it semiconductors, hardware, communications equipment, or the like, where, like we just said, you have manufacturing sites and supply chains to think about. And the other bucket is more people-focused businesses like software, IT services, internet, which typically don't have a lot of hard assets. And it's really more driven by the people and where they sit and how to deal with that. So my first question for you, for the manufacturers in the audience, there already is a very direct impact from tariffs. Where do you see the biggest impact, and what are companies telling you how they look at mitigating that impact?
Thanks for the question, Andreas. And you're absolutely correct. There's a lot of uncertainty going around right now, a lot going on for tech manufacturing, especially. It's really tariff uncertainty that I keep hearing dominate the discussion among CEOs, CFOs, and in boards in the tech sector. Just to level set what we're expecting, we're really bracing for a COVID-like supply shock for the United States and even globally. So I think if you're a tech manufacturer, you can expect increasing costs and prices for your electronic components, especially if you're sourcing from Asia. A lot of the key tech manufacturing hubs in Asia were hit with huge reciprocal tariffs on Liberation Day, April 2nd. So, you're looking at Vietnam with a 46% tariff rate, Taiwan 32%, India 26%, South Korea 25%, Japan 24%. Now, all that's been put on hold for a 90-day pause and have been rolled back to the 10% kind of universal tariff. And the other kind of new nugget, of course, was the fact that smartphones, computer chips, and other electronics were exempt for about a month or two. And in fact, we're expecting in the next week or two, the government to complete their Section 232 investigations into national security around semiconductor manufacturing. So we could see those tariff rates on semiconductor chips moving up into 25. In some cases, people are expecting tariff rates as high as 100%. So a lot of uncertainty there. Of course, we've got sectoral tariffs on steel and aluminum. And we've got retaliation from China in rare earths and magnets. So they're really limiting exports. So if you're in the defense sector or, information technology space and, you're trying to produce jet engines or electric vehicles or advanced missile components, you're being impacted by all this. So how are tech manufacturers positioning for this? Well, obviously expecting disrupted supply chains and squeezed profit margins, at least for a time. I think it's really going to depend on where the final tariffs land in terms of magnitude and, of course, the duration of those tariffs. Now, the president's been teasing, negotiations with China and other countries and a potential rollback of some of these tariffs. But until we really see the details on that, it's really going to be hard for folks to I think the bottom line here is that the tariff shock is likely to be 5x what we saw the first time around, Andreas, and that's why economists are so alarmed. Obviously, we can't recreate our technology supply chains. The more complicated the product you're producing, the more difficult it is to adjust your supply chains. And on top of that, we're probably going to have more cautious consumer and business, right? Business investment spending is deteriorating. Consumer confidence has plunged. And some of the survey data suggesting there's been a little bit of a pull forward in demand for tech and electronics as we try to import and beat the tariffs. But that's probably going to lead to a sharp slowdown in sales in the end of the second quarter and third quarter. On a positive note, a couple of things. I think if you're a tech manufacturer based here in the U.S., a couple of things. The CHIPS Act that was passed in 2022 is still there for the moment. There's some political uncertainty there, but there's still about 40% of the pot of about $40 billion for tech semiconductor manufacturing still available. So that's something to keep an eye on. And we do think that smaller and mid-size manufacturers, component manufacturers in the U.S. will benefit from as orders shift more domestically. So there are going to be some winners from these tariffs, and I think the smaller manufacturers may be better positioned some of the bigger players there.
And maybe just doubling down on that just for a second. I know we've got to keep going because there's a lot of ground to cover in little time, but from a manufacturing perspective, it doesn't mean, well, two very different sides of the equation, but nevertheless, it almost doesn't matter if you're in Canada or the US. Flexibility is the key word for everyone. If I going back to my earlier point about manufacturing, for example, bringing production back into your respective country, great. In some cases, it might be easier than others. If you think about the semiconductor industry that you just referred to, right? Building state-of-the-art fab close to $20 billion, it's not an overnight exercise, not even a one-year exercise, maybe not even a two-year exercise. And then the other element is the state-of-the-art, top-of-the-line photolithography machines. There's one company in the Netherlands that makes them. There's about 3 companies in Japan that are really supply the lion's share of the chemicals that go into semiconductor manufacturing process. And then in the US, we're really, really good at semiconductor design software. So even if you decide like, hey, we want to do everything in our country right now, you can't just pull it off. So going back to my earlier point, what you just alluded to, right? Like the flexibility around shifting supply chains around flexibly adapting an environment that keeps changing on an ongoing basis. I think is key. We could talk about this for hours, I know, but just moving on, the other bucket that I referred to, so the non-manufacturing businesses, the impact would be more indirect, but nevertheless highly relevant, right? So same question as before, where do you see the biggest impact, and what are companies telling you how they look at mitigating that impact?
Yeah, well, the first point I'd make is there's nowhere to hide from these tariffs. So if you're in IT services or software, e-commerce, say AI services or cloud infrastructure, you're going to see cost increases and price increases. Obviously, the backbone of these virtual software industries is still hardware, right? So it's servers, it's network equipment, it's semiconductors. And so you are going to see impacts there across a broad cross section of these firms. Another wrinkle I think that's important for software and services, including AI, is the war for talent, right? As we see more nationalistic trade and immigration policies, it's going to, really reduce the access globally to talent. You may have to source talent more domestically. And so that's, I think, maybe a new battleground that we're going to see develop here in the days and weeks ahead. So what am I seeing in terms of, impacts? Obviously, there's been budget cuts, constraints. Some IT service businesses are investing more in the U.S. if they can. But what I'm hearing a lot from CEOs and CFOs, they're really still just taking a wait and see approach, right, before they invest huge sums of money in expanding up, back to your point, Andreas, until, building a fab or increasing your capabilities in the country really requires a long time horizon. And obviously we don't know where the tariffs are going to end up or how long they're going to be in place. But I do see a lot of this really accelerating kind of the enhancement of AI capabilities, right, as companies try to boost productivity and reduce costs. And so I think that's one area. So obviously, even software, they're looking to diversify vendors, supply chains, looking at their sourcing strategies. For e-commerce companies, it's really been the end of the de minimis exemption on shipments from China, low-valued goods that are being impacting a lot of the players like Shopify and Amazon and BigCommerce and others. In cloud infrastructure, it's the Amazon, Microsoft, and Googles of the world. In cloud infrastructure, costs are rising, and in AI services, I think it's more the talent issue, and will this slow longer term development collaboration across countries, across platforms, and across talent pools. So that's kind of how I'm thinking about it right now, Andres.
Thank you, Scott. Really appreciate it. I know, unfortunately, we have to move on. We're just scratching the surface here, but we got a lot of ground to cover. I will add one comment, though, before we move on. In the context of like adapt to survive, in a sense. I was talking with an IT services company yesterday, and they, for example, pivot. It's not the only thing they do, but they pivoted, and they now added, they created a piece of software that helps people analyze the impact from tariffs. Now, how that affects their businesses, and so to better analyze and deal with the situation. So they're actually trying to basically turn this into something that helps their business. Moving on to the other Mr. Anderson on the call, Brett Anderson, our colleague on the rate side. So just keep it going, Brett. What have you seen companies do to manage the interest rate risk during these times of volatility?
Yeah, good question. Yeah, I mean, first off, for companies that either have or expect to have interest rate exposure to hedging the variability of the underlying index in these uncertain times is just prudent risk management. Rate hedges are going to help fix the cost of capital, protect against volatility in those short-term rates, and reduce budgeting uncertainties. Each of that is going to contribute to a company's financial stability. So, moving to your question, and more along the lines of what Dr. Anderson was touching on earlier. I mean, the past several weeks, we've seen material increases in volatility as market participants have tried to sort through the implications of Liberation Day, the continuous changing of tariff headlines, commentary from market specialists, and all to assess the likely impact of the administration's tariff policy on growth and inflation, and of course, Fed policy going forward. Financial markets are generally speaking, they're forward-looking. Despite Fed Chairman Powell's repeated messaging for patience by the decision making by the FOMC. Projected rates, those have diverged and are currently expecting aggressive easing through the remainder of the year and into 2026. And so, these changes to the forward curve have pushed swap rates lower than that of the term variable rate of say, SOFR. And in many cases, this is creating significant positive carry when swapping floating rate debt to fixed. And clients have viewed these recent moves as opportunistic entry points, and the rates team has seen significant increase in activity. We are seeing sideline clients, booking hedges for the first time. We're seeing existing clients both increasing their fixed percentage from a global perspective, and we're also seeing clients that are extending duration of existing hedges as that forward curve has come off. So, our corporate sales and structuring rates team, it consists of global markets advisors. We're spread across the U.S. and Canadian footprints. We're here to help companies advise on the most or the best course of action in these uncertain times. Whether that's determining the most appropriate fixed versus floating rate composition, using derivative products to hedge anticipated public or private bond issuance ahead of pricing, hedging cross-border rate risk with the use of cross-currency swaps, or even to facilitate the introduction to other global markets teams, such as commodities, ESG, or maybe a great segue here, Andreas, is it's to the FX team, which is going to be helping hedge those fluctuations in world currencies.
Thank you for the segue, Brett. But before we get to Sherilyn, one quick comment. So directly related to rates, just in general, the capital markets, so the investment capital markets out there, strategic deals are still happening, right? M&A is still happening. The valuations might change, but that's still happening. What we're seeing a lot less happening nowadays is opportunistic deals, opportunistic refinancings. And one specific example is if you have a credit facility that matures, let's say sometime next year, would go current sometime this year. Traditionally, people used to look as trying not to go current, so it doesn't show on the filings, it just look good. What we're seeing companies do more and more is actually saying, like, you know what, I'd rather go current and keep the very attractive terms I locked in 4 years ago than to redo a deal at the current pricing, or more importantly, even structure that you can get in the current market. But so again, thanks for your segue, Brett. Moving on to Sherilyn. So same question as for rates, now to our FX strategist. What are some best practices for companies to think about when it comes to FX risk?
Sure. As the other speakers have already shared, we've seen how on again, off again tariffs have created uncertainty and volatile market moves. Companies that have a well-defined FX hedging policy that clearly lays out a strategy and a process are going to be best positioned to react to changing market developments like the tariffs. Why is that? Well, we've already touched on a lot of that because tariffs have a significant impact on cash flows, margins, and supply chains, which all creates unforeseen currency risks. It's beyond the scope of this discussion to get into any detailed description of best practices for FX hedging policy, but some of the major components need to cover the FX policy objective. Is it to minimize the impact of FX swings on the bottom line, achieve a budget rate, etc.? Exposure quantification, a hedge toolkit that lists allowable products and hedge ratios and durations, and also some post-hedge analysis to see if what you intended to do is actually meeting the objective. So if you don't already have a policy in place, events like the recent ones certainly serve as a call to act. As you can imagine, without any kind of framework, it's pretty difficult to evaluate the success of any FX hedge activity because you're going to have nothing to compare it to. Looking at handling the tariff events specifically, what it really comes down to is how all the uncertainty impacts the quantification of your FX risk. Since tariffs seem to be changing by the hour, quantifying that impact is a lot easier said than done. But in terms of best practices, we have seen clients attach less certainty to their forecasted cash flows and therefore choosing shorter durations for hedging, for example. We've also seen astute clients pivoting away from forwards and using more options. Like if you lock in with a forward and the exposure doesn't materialize, a loss can result when you need to close out the position. So what we're seeing in the current environment is a much more willingness on the part of clients to purchase protection with options. Since if it ends up that the hedge isn't required, the most that you're going to lose is your premium. Well, we've also seen clients add more forward alternative structures into the mix because they can offer you greater flexibility over a forward. They still are going to protect you from unfavorable moves and also allow for some protection in favorable ones. And finally, we've seen clients more active in restructuring trades. An example of this could be what we've seen is like clients blending and extending contracts further out. And in the process, they're able to perhaps reduce leverage and or the amounts. So really to sum up, best practices center around having a sound hedge policy in place to begin with, and then taking a proactive or dynamic approach, certainly in these uncertain times, in some of the ways that I've touched on. And as Brett pointed out, your partners in BMO Capital Markets are happy to help and have discussions with you about your FX policy formulation or customize hedge solutions to address your specific objectives. And I'll leave it there.
Thank you, Shirley.
Thanks.
Thank you. Appreciate it. Very insightful. Moving on to our last panelist before we get to Q&A, Nick. So global trade, obviously this is a topic that's top of mind for you. Talk to a lot of your clients about this, especially as it relates to companies that actually manufacture things, have to do with supply chains. It's the sweet spot for global trade, right? So you must have gained quite a few insights. If you mind sharing those, I'd really appreciate that.
Yes, absolutely. So, it's harder to predict the U.S. trade policies long term, but regardless, many buyers are taking more proactive measures now to revisit, renegotiate their supplier contracts. And for example, a number of buyers, not just in the technology sector, are using suppliers located in high tariff countries. They're delaying shipments of invoiced goods. So these buyers are essentially playing a waiting game in hopes tariffs decrease or roll back entirely. So the decision not to ship and take on higher costs of inventory says a lot about the outlook of sales and demand. On the flip side, a particular number of buyers in the U.S. are taking shipments actually are repricing multiple products differently. So essentially, the repricing strategies seems to be that they're passing tariff costs to higher priced goods that are in high demand, while the lower demand goods are not seeing that pricing path. So, some sectors are hit harder, some sectors are not. For example, in the technology sector, semiconductor demand is extremely high. So it's critical now that these semiconductor companies take some proactive measures to ensure that the global supply chain network liquidity is safeguarded. One effective solution that BMO has offered for 25 years is supply chain finance. Thank you.
Thank you, Nick. Very insightful on some very specific ideas that you shared, what some of your clients are doing, very specific action steps. I'd love to go deeper into all these topics. We unfortunately can only scratch the surface today. But like SL, I was in the closing comments. I'm going to tell you all, hey, if you want to dive deeper, just reach out to any one of us or to BMO banker, and we'll happily help you. So let's move on to the Q&A. We did get quite a few questions. The first one, I think actually probably Dr. Ernest and myself can take. So the question is, has the U.S. government made any exceptions in case material or equipment related to semiconductors is not available in the U.S. at all? Similar exception was made by the Chinese government related to semiconductor material. To Dr. Anderson's point earlier. Yes, I thought I heard something like that too. Could it happen? Yes. Could it not happen? Yes. We'll find out when it happens. I think it goes back to my earlier point about flexibility, what we also didn't touch on, what we saw happen during the pandemic a lot. It's not really materials, but it is the supply chain. It's designing components out of your product, designing in another component that you actually have access to. So that is one option that people could look at. But Scott, do you have any particular perspective from your seat on this whole topic of, semiconductor, potential material shortages, and if there might be an exception? Have you heard anything?
Yeah, well, obviously the rare earths export ban could weigh. I mean, I think we're obviously hoping that there's a rollback of some of these tariffs and that the trade war cools in the weeks ahead. I think our window is closing, though. I think, maybe next 30, 60 days, we need an agreement or a rollback of some of these tariffs. I think Wall Street right now is thinking that maybe we'll get a baseline universal tariff of around 10%, maybe 25 to 50% on China, kind of as the new normal after the negotiations play out. But we don't really have a lot of clarity on that. I mean, I think so. I think what you're seeing is a lot of folks trying to stockpile where they can, and I think your point, Andreas, about shifting to producing chips or things that you'll have a steady supply of is something that folks might have to fall back on. No, it would be a disaster if the semiconductor manufacturing supply chains broke down. Obviously, one of the biggest concerns is, China's blockading of Taiwan or something like that, on top of what we're seeing here from the tariffs. So there's a lot of uncertainties here. But I think, like you said, the outlook for semiconductors is quite strong right now. There's big chip demand. We're still ongoing building fabs in the U.S. That's been ongoing since the CHIPS Act, and so there's opportunities for growth here. So nimble companies that can pivot quickly and adjust their strategies will be well positioned to take advantage of these changes.
Thank you. And just rapid shot, quick round. I'll try to get as many questions through in the remaining time that we have. So this question here seems to be a good one it's obviously a good one for Brett. So how should companies think about managing rate risk in an environment when the next move by the Fed is more likely to be lowering short-term rates and not increasing them?
Yeah, a very good question, and I'll try and keep it short given the time. Earlier I touched on markets being forward-looking, and so term rates are built off of this forward curve. So they include the projected rates over the duration of the hedge. And so, said another way, and I'm speaking a bit simplistic here. A 3-year swap, for example, that's hedging the variability of SOFR, equals the average of where the market expects SOFR to reprice over the same 36-month period. And so in today's environment, that includes those projected easings that I touched on. With that said, I mean, we know for a fact that the actual evolution of SOFR is going to be far different than what was projected at day one, especially over the longer time frame. In fact, the data suggests that the statistical relationship between projected forwards and actuals starts to drop off after just a few short months and becomes essentially obsolete, in less than a year. And so my point is that just because markets are pricing in a particular path forward, the likely outcome is going to be far different, especially as you move out further in time. And hence, hedging your rate exposure in any rate environment is just prudent risk management.
Thank you. And let's try and squeeze in one more question. It'll have to be quick. And I think this one is a good one for Scott, building on kind of the earlier conversation that we had. So what if we get a new lower tariff agreement with China? How does the outlook change? And if you can squeeze into a minute, I know it's almost impossible, but give it a shot.
Yeah, it would be very helpful, I think. But I think the supply chain shock is already underway. I mean, if you look at what's happening with port activity in LA, Long Beach, volumes coming from China are down about 40% right now already. And so I think we've, like I said, a very short window, maybe 30 days or so to get an agreement in place before we start marking down our growth forecasts again and maybe raising our expectations around shortages on retail shelves and inflation. Obviously this works its way through. So in about a month's time, a little bit more than a month's time, you're going to see some products shortages in retailers in certain areas. And even if we do get an agreement, it takes, a couple, 3 weeks to reposition ships and everything else on the logistics side. So we're not completely out of the woods yet. So, obviously this would help business and consumer confidence and probably raise the risk that the inflation is a temporary thing, but it won't completely protect us. There's been some damage done. So I want to thank you for joining us. Hopefully you got some important information to help you navigate this, the tariff shock and how it's impacting the tech industry. Please reach out to any of us on the banker side or on the analyst side. We're happy to help our customers and clients and help you navigate this whole thing as we all try to see where we're going in the days and weeks ahead. So thank you very much, and we'll be speaking soon.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.